When I talk about filtering out bad trades, I'm not talking about being clever or fast or flashy. I'm talking about being patient, and that is something most men in this game don't have. I learned early on that the market does not pay you for activity. It pays you for judgment. You don't get rewarded for how many times you pull the trigger. You get rewarded for waiting until the market lines up with what you already know. Now tell me, have you ever taken a trade just because you were tired of watching price move without you? That right there is how bad trades get into your account. Not because you didn't know better, but because you didn't wait long enough for better to show up. A bad trade almost always comes from impatience dressed up as opportunity. The tape will wiggle, a bar will poke up, and suddenly the mind starts making up stories. But price doesn't care about your stories. It only cares about supply and demand. And if you can't see a clear imbalance, you're guessing, not trading. Have you noticed how the best trades almost look boring before they work? I used to think I needed to be in the market to make money. But over time, I learned the opposite was true. The market gives you money when you are not in it, when you're waiting for it to tip its hand. A stock that is drifting sideways, churning volume, or moving on no real force is not telling you anything. It's just noise. And noise is where bad trades are born. The quiet moments, when nothing seems to be happening, that's where you sharpen your edge. Are you willing to do nothing when there's nothing to do? Filtering out bad trades starts with knowing what a good trade actually looks like. A good trade is not a feeling. It's a condition. It's a price that has moved out of congestion with force, or one that is pulling back in an orderly way after showing its strength. It's a situation where the big money has already started to move, and you're simply stepping in behind it. Anything else is you trying to be smarter than the market. And I'll tell you, the market has a way of humbling smart men. Have you ever noticed how losing trades always feel rushed? When a stock is ready to move, it doesn't need you to push it. It goes on its own, volume expands. The spread widens. The closes get stronger. That's not subtle. That's the market speaking plainly. But bad trades come when we ignore those clear signs and start trading because we're bored or afraid of missing out. And fear is not a trading plan. Fear makes you chase. And chasing puts you in late. And being late is just another way of being wrong. How many times have you bought right at the top because you couldn't stand watching it go without you? The biggest filter you have is your own discipline. Charts don't make bad trades. Traders do. A chart will show you the truth if you're willing to look at it without wanting it to say something else. If price is stuck, you stay out. If the trend is down, you don't look for a reason to buy. If the volume is drying up, you don't pretend it's building. You let the market come to you, and that takes a mindset that values preservation more than excitement. Do you really believe that sitting on cash is a position? Cash is the trader's shield. It keeps you alive for the next real opportunity. Most people think being out of the market is wasted time. But I found that most of my money was made by waiting, not trading. Waiting for the right setup, the right alignment, the right moment, when risk was small and potential was clear. Bad trades come from wanting action more than results. Good trades come from wanting to protect your stake. Are you trying to be entertained, or are you trying to be paid? Another thing that filters out bad trades is having a clear line in the sand before you enter. If you don't know where you're wrong, you don't know why you're in. A trade without a defined risk is not a trade. It's a hope, and hope is expensive. When you take a bad trade, you usually can't even tell when it's gone bad, because you never decided what bad was in the first place. Isn't it strange how people will risk their money without knowing how much they're willing to lose? The market is not there to take your money. You give it away when you ignore your own rules. If a stock doesn't move the way it should after you enter, that's information. You don't argue with it. You don't make excuses. You step aside. Bad trades often start as small mistakes that are allowed to grow. A good trader cuts them off early, not because he's afraid, but because he respects his capital. Can you accept being wrong quickly, or do you need to be right? You see, filtering bad trades isn't just about charts. It's about how you think about money. If you treat every dollar like it's meant to be protected and grown, you won't throw it into low-quality setups. You won't chase moves that already ran. You won't gamble on weak patterns. You'll wait for the market to give you something solid. That's how wealth is built in trading, not in big bursts, but in steady, careful accumulation. Are you building or are you just swinging? Most bad trades have something in common. They don't feel calm. They feel urgent. You feel like you have to act now or miss out. But the best trades feel almost obvious. They line up with the trend. They come after a proper pause. They break out with volume. There's nothing forced about them. If you find yourself trying to convince yourself to take a trade, that's usually your cue to walk away. Have you ever noticed how you can talk yourself into almost anything if you try hard enough? I learned to filter by asking simple questions. Is the trend clear? Is the stock acting strong or weak? Is volume supporting the move? Is there room for it to go? If the answer isn't clear, I don't trade. Simple as that. Complexity doesn't make you more profitable. It just gives you more ways to be wrong. The market is hard enough without you making it harder. Why make a trade complicated when the best ones are usually simple? A trader who avoids bad trades will beat a trader who chases every move, even if the second one has more winning trades. Losses hurt more than wins help. That's a lesson most people learn too late. By filtering out low-quality setups, you're not missing opportunities. You're avoiding unnecessary damage. And avoiding damage is the first step to making steady money. Doesn't it make sense to protect what you already have before trying to get more? The tape will always offer you something to do. There will always be a stock moving, a chart breaking, a story unfolding. But not everything that moves is worth your money. Your job is not to trade everything. Your job is to trade the right things. That means letting most of the market go by without you. And that's not weakness. That's selectivity. That's professionalism. Are you willing to let other people have the small moves while you wait for the big, clean ones? Cash is an active position, not a missed opportunity, and most traders never truly understand that until they've already paid a heavy price for ignoring it. They look at cash as if it's something lazy, something that isn't working, something that should always be put into motion. But in trading, stillness is not weakness. Stillness is readiness. When you hold cash, you are not sitting out of the game. You are choosing not to make a bad move. That choice has real value, even though it doesn't show up as a flashing number on your screen. Every time you don't take a low-quality trade, you are making a decision that protects your future trades. You are keeping your capital intact so that when the right setup appears, you have the freedom to act. A trader who is fully invested in weak positions has no flexibility. He's trapped. His money is stuck, his mind is anxious, and his attention is scattered. Cash, on the other hand, gives you clarity. It gives you space to think. It lets you see the market without needing it to do something for you right now. Most bad trades come from feeling like you have to be in something. You start believing that if you are not in a trade, you are falling behind. But the market doesn't work on a schedule. Opportunities don't show up just because you are ready for them. They show up when conditions align. When you keep your money in cash during unclear or choppy markets, you are not losing time. You are avoiding confusion. You are avoiding the small, frustrating losses that drain both your account and your confidence. There is a kind of emotional relief that comes from being in cash. You are no longer reacting to every tick. You are no longer hoping that price will move your way. You are simply watching, and when you watch without needing a result, you see things more clearly. You notice when volume starts to build. You see when a stock stops going down. You recognize when a range is about to break. Those are things you miss when you are already in a trade and emotionally tied to its outcome. Being in cash also means you are not forced to compromise. When you are desperate to trade, you lower your standards. You take setups that don't really meet your criteria. You accept less than what you know you should. But when your money is sitting safely on the sidelines, you can be selective. You can wait for the chart to look exactly the way you want. You can wait for price to come to your level instead of chasing it. That selectivity is what separates consistent traders from gamblers. Many people think that holding cash means you are afraid. In reality, it often means you are disciplined. You are saying that your capital is important enough to protect. You are saying that not every market condition deserves your participation. There are times when trends are strong and clean, and there are times when everything is messy and unpredictable. Cash lets you step back during the messy times. You can step forward with confidence when clarity returns. Cash also gives you psychological stability. When you are in a losing trade, even a small one, part of your mind is always tied up with it. You are thinking about where to exit, how much you're down, what will happen if it moves against you. That mental load makes it harder to see new opportunities. But when you are in cash, your mind is free. You can observe without pressure. You can plan without stress. That mental freedom is just as valuable as financial freedom in trading. There is also the idea of opportunity cost. Some traders think that if their money is not invested, they are missing out on potential gains. But money tied up in a bad or mediocre trade is also missing out on better opportunities. Cash is liquid. It can be deployed instantly. If a perfect setup appears, you don't have to close something else to take it. You are ready. That readiness is a form of power in the market. When markets are choppy, cash often outperforms trading. A string of small losses can be more damaging than doing nothing at all. Those losses reduce your position size, shake your confidence, and make you more hesitant when a good trade finally comes along. By staying in cash during uncertain conditions, you preserve both your capital and your emotional balance. You stay in shape for when the real opportunities arrive. Cash also helps you avoid revenge trading. When you take a loss and you are still in the market, it is easy to jump into another trade just to try to get your money back. That usually leads to more mistakes. But if you step back into cash after a loss, you create a pause. That pause gives you time to reset. It lets you review what happened and decide what to do next from a calm place instead of an emotional one. There is a quiet confidence that comes from knowing you don't have to trade. You are not dependent on the next candle or the next news release. You are in control of when you engage. That sense of control makes you a better decision maker. You are not chasing, not forcing, not reacting. You are waiting for the market to invite you in. Over time, treating cash as an active position changes the way you think about trading. You stop seeing it as something you must always be doing, and you start seeing it as something you choose to do. That shift is subtle but powerful. It moves you from being a participant who is dragged around by the market to one who engages on his own terms. Cash is also what allows you to size properly when a real opportunity appears. If your money is spread across several weak trades, you can't put enough into the one that really matters. But if you have been patient and kept your capital available, you can commit more confidently to the best setups. That is how a few good trades can make a big difference over time. Holding cash teaches you patience in a very real way. You are training yourself to be comfortable with not acting. That is not easy in a world where everything moves fast and everyone is always doing something. But in trading, the ability to wait is often more valuable than the ability to act. The market rewards those who can sit quietly until the odds shift in their favor. When you see cash as a position, you stop feeling left out when the market moves without you. You understand that there will always be another opportunity. You don't need to catch every move. You only need to catch the right ones. That understanding takes pressure off every decision you make. Cash also acts as a buffer against overconfidence. After a series of wins, it is easy to start thinking you can't miss. You trade more, you take more risk, you loosen your rules. Keeping a portion of your capital in cash helps keep you grounded. It reminds you that not all money needs to be in play at once. That restraint is part of success. Every trade must earn the right to be taken, and that idea alone would save most traders more money than any fancy indicator ever could. People like to believe that opportunities are everywhere, that the market is constantly offering chances to make money, But that belief is exactly what leads them into trouble. The market is always moving, yes, but movement is not the same thing as opportunity. A trade is not something you take because a stock is ticking up or because a candle looks interesting. A trade is something that must prove itself to you before you risk a single dollar. When you understand that a trade has to earn its place in your account, you stop chasing every little fluctuation. You begin to see that most price action is just noise, a tug of war between buyers and sellers that does not yet resolve into anything meaningful. If you step into that noise, you are not trading with an edge. You are just gambling on which side will blink first. But when you wait for a clear break, a strong trend, or a well-formed pattern, you are letting the market do the hard work for you. A trade earns the right to be taken when it shows you that something real is happening. That might be a surge in volume, a decisive move out of a range, or a series of higher highs and higher lows that tells you buyers are in control. These are not subtle clues. They are the market speaking plainly, but you only hear them if you are willing to ignore everything else. Most traders get distracted by every flicker on the screen. They see movement and they feel compelled to act, even when there is no real structure behind it. Requiring a trade to earn its place also means you have standards. You know what a good setup looks like, and you don't compromise on it. If a stock almost fits your criteria, but not quite, you let it go. That discipline is uncomfortable at first because it feels like you are passing up chances. But in reality, you are passing up risk. You are saying that your capital is too important to be put into something that doesn't meet your requirements. This way of thinking changes how you experience the market. Instead of feeling like you are always on the hunt, you start to feel like a gatekeeper. Trades come to you, and you decide which ones are worthy. That shift in mindset gives you a sense of control. You are no longer reacting to the market. You are evaluating it. You are not asking, "Can I make money here?" You are asking, "Has this earned my money?" When a trade has not earned the right to be taken, it often shows in subtle ways. The chart looks messy. The volume is inconsistent. The trend is unclear. You might find yourself making excuses for why it could still work. Those excuses are red flags. A good trade doesn't need you to talk yourself into it. It stands on its own. It has a logic to it that is visible on the chart. When you start justifying a trade, you are usually trying to override what the market is telling you. There is also the matter of timing. A setup might be valid, but if the timing is wrong, it hasn't earned its place yet. Buying too early can be just as bad as buying the wrong stock. A trade earns its right when price confirms your idea. That confirmation might be a breakout, a bounce from support, or a hold above a key level. Until that happens, you are only dealing with a possibility, not a probability. This approach protects you from one of the biggest dangers in trading, which is anticipation. Anticipation feels smart because you think you are getting in ahead of the crowd, but most of the time, you are just getting in ahead of the move, which means you are exposed to all the risk without any of the proof. Letting a trade earn its place means you wait for the crowd, or at least the big money, to start moving first. You don't need to be first. You need to be right. Another benefit of this mindset is that it naturally limits overtrading. If only a small percentage of setups truly earn the right to be taken, you will take fewer trades. Fewer trades mean fewer chances to make mistakes. They also mean that when you do take a trade, it is more likely to be a good one. Quality replaces quantity. That is how consistency is built. When you make a trade earn its place, you also become more comfortable with doing nothing. You are not constantly looking for something to click on. You are waiting for something that meets your criteria. That waiting can feel boring, but it is also where your edge grows. While others are chopping themselves up in random moves, you are preserving your capital and your focus. This way of trading also forces you to be honest with yourself. You can't hide behind vague ideas or gut feelings. You have to be able to say why a trade deserves your money. You have to be able to point to something on the chart that justifies your risk. That clarity makes it easier to manage the trade once you are in it. You know what should happen, and if it doesn't, you know you are wrong. A trade that has earned its right also makes it easier to accept losses. When you have followed your rules and taken a setup that met your standards, a losing trade feels like part of the process, not a personal failure. You did what you were supposed to do. The market just didn't follow through this time. That kind of loss is much easier to handle than one that comes from a sloppy or impulsive decision. Over time, this discipline compounds. You avoid the big mistakes that wipe people out. You keep your drawdowns smaller. You stay in the game longer, and staying in the game is what allows you to catch the moves that really matter. Most fortunes in trading are not made by catching every swing. They are made by being around when the big trends show up. Requiring trades to earn their place also changes how you look at charts. You stop trying to predict what will happen next and start focusing on what is happening now. You become a reader of price rather than a storyteller. You let the market reveal its intentions before you commit your money. That makes you more aligned with reality, and reality is where profits come from. Boredom creates losses faster than bad analysis, and that truth sneaks up on more traders than any chart pattern ever will. You can be sharp, you can understand trends, support, resistance, volume, and still slowly bleed money simply because you cannot stand sitting still. The market has long stretches where nothing clean is happening, where price moves back and forth without conviction, and during those stretches the greatest enemy is not the market, it is your own restlessness. When a trader is bored, the mind starts looking for stimulation. It starts to turn small movements into big stories. A tiny breakout looks like the beginning of a major run. A random bounce starts to feel like a reversal. The eyes see what they want to see because the mind wants something to do. And once that happens, discipline quietly steps out of the room. You start clicking because it feels better than waiting, even though you know deep down that the setup is weak. Bad analysis at least has structure. It comes from trying to interpret real data, even if the conclusion is wrong. Boredom, on the other hand, doesn't even pretend to be logical. It pushes you into trades that you would never take if you were calm and patient. It makes you lower your standards without realizing it. A stock that would normally be ignored suddenly looks interesting, simply because it is moving. This is why some of the biggest losses come on quiet days. The market is slow, the charts are flat, and nothing is really happening. That is exactly when traders start inventing opportunities. They take marginal setups, trade small ranges, and jump in and out for no real reason. Those little losses add up, and worse than that, they train the trader to associate activity with progress, even when there is no progress at all. Boredom also makes you impatient. You start to feel like if you don't trade, you are wasting time. You forget that waiting is part of the job. You forget that the best trades usually come after long periods of nothing. Trends don't appear on demand. They build, they pause, they gather energy, and then they move. If you are too busy trading noise, you are often not ready when the real move starts. There is a subtle emotional pull that boredom creates. You begin to crave the feeling of being in a trade. Watching numbers move, seeing green or red on your screen, feeling involved. That feeling can be addictive. It makes you want to be in the market even when the market has nothing to offer. You start trading for the experience rather than for the opportunity. This is how boredom quietly turns into overtrading. One trade becomes another, then another, all based on thin reasons. You might tell yourself that you are just being active, that you are staying sharp, but in reality you are just feeding the need for stimulation. The market does not reward that need. It punishes it. Boredom also interferes with your ability to follow your plan. You may have rules about only trading strong trends or waiting for certain patterns, but when you are bored, those rules start to feel restrictive. You think, maybe just this once, maybe this setup is close enough. That is how a solid trading plan slowly gets eroded, not by big dramatic mistakes, but by a series of small compromises made in moments of restlessness. One of the hardest skills in trading is learning how to be bored without acting on it. To sit in front of the screen, watch price move in circles, and do nothing. That feels unproductive, but it is actually a form of discipline. You are protecting your capital and your focus. You are telling yourself that you only act when the market gives you a real reason. Boredom also clouds judgment. When you are engaged in a good trade or watching a clean setup develop, your mind is focused. You are alert. But when you are bored, your attention drifts, you miss important details. You see what you want instead of what is really there. That makes it easier to make careless mistakes, like entering too early, placing stops poorly, or ignoring warning signs. Another way boredom causes losses is by making you hold on to bad trades longer. When nothing else is happening, a losing trade becomes your main source of stimulation. You watch it tick up and down, hoping it will turn around, because at least it is something to look at. Instead of cutting it quickly and going back to cash, you stay in, letting a small loss grow simply because you don't want to be flat again. Boredom also pushes traders to switch markets, time frames, or strategies just to feel busy. They jump from one chart to another, from stocks to options, from short-term trades to long-term ones, not because it fits their plan, but because they are restless. That constant shifting prevents them from developing consistency. They are always starting over, always chasing something new. The market has a rhythm. There are times of action and times of rest. When you fight that rhythm, you end up fighting yourself. You trade when there is nothing to trade, and then you are tired or frustrated when the real opportunities finally show up. Boredom has already drained your patience and your confidence. Learning to handle boredom is really about learning to respect the market's timing. You are not in charge of when opportunities appear. All you can do is be ready for them. That means staying mentally fresh, not burning yourself out on low-quality trades just to fill the time. Some of the most successful traders are the ones who trade the least. They wait, they watch, and when they act, it is because something meaningful is happening. They are not in the market to entertain themselves. They are there to apply their edge when it appears. Boredom makes you forget that. It makes you think that any movement is an opportunity, that any day can be a trading day. But most days are not meant to be traded heavily. They are meant to be observed. They are meant to be used to study how price behaves, how volume shifts, how trends form and fade. Strong trends forgive mistakes. Weak markets punish them. And that single idea explains why so many traders feel like the market is unfair. It isn't unfair at all. It is just very honest about the environment you are trading in. When a market is trending with real strength, it has a kind of momentum that carries price forward, even if you don't get in at the perfect spot. You can be a little late, a little early, or slightly off on your timing, and the trend can still bail you out. But when the market is weak, choppy, or directionless, even the smallest mistake gets magnified. In a strong trend, the crowd is aligned. Buyers are buying or sellers are selling with conviction. Volume supports the move. Pullbacks are shallow and quick. The price keeps making progress in one direction. In that environment, the market is doing most of the work. You are just along for the ride. That is why strong trends are so forgiving. You can make a less then perfect entry and still see profits because the underlying force is pushing in your favor. Weak markets are the opposite. There is no clear force. Buyers and sellers are in a constant tug of war. Price moves a little, then stalls, then reverses. Volume is inconsistent. Nothing has follow through. In that kind of environment, the market is not helping you. It is testing you. It is exposing every flaw in your timing, your risk management, and your patience. You have to be much more precise just to break even. This is why so many traders struggle when conditions change. They might do well during a strong bull run or a clean downtrend, then give it all back when the market goes sideways. They are using the same habits in two completely different environments. What worked when the trend was strong stops working when the market loses direction. A strong trend creates a tailwind. If you are trading with it, it pushes you forward. Even if you stumble a little, the wind keeps you moving. A weak market has no tailwind. It is more like walking on loose gravel. Every step has to be careful, or you slip. If you are aggressive in a weak market the same way you are in a strong one, you will quickly find yourself in trouble. This is why the first thing a trader should always ask is not, is this a good stock? But, what kind of market am I in? Are trends holding? Are breakouts working? Are pullbacks being bought? Or are moves failing, ranges breaking and then reversing, and nothing following through? The answers to those questions tell you how much room for error you have. In a strong trend, you can focus more on riding the move. You can give your trades more room. You can let profits run. The market rewards patience in that environment because it wants to keep going. In a weak market, you have to be much quicker. You have to take profits faster, cut losses faster, and be more selective. The market is not offering much, so you cannot afford to be sloppy. Many traders don't realize that their losses are not always about picking the wrong stock. Often they are about trading the right stock in the wrong environment. A great breakout in a weak market can fail just as easily as a poor one. A strong pattern needs a strong backdrop to work. Strong trends also help with confidence. When you see trade after trade working, you feel calmer. You trust your system. You are not constantly second-guessing. That mental state makes it easier to execute well. In weak markets, losses come more frequently. Even good setups fail. That can make you hesitant, which leads to late entries, early exits, and more mistakes.